Hi guys, welcome back to DivyFX. If you watched the last video, I talked about some beginner-friendly forex terms that every trader needs to know. But guess what? We didn't finish it. We did not finish it. So today, I'm going to be talking about the part 2 of that very episode. And this time, we're going to be diving a little deeper. So we're going to be talking about 4 major things every beginner should understand before clicking the buy or the sell button on any trade. Because if you don't know these are like most of the part of the basics. So the first one here is your currency pairs, second the risk to reward ratio, thirdly break of structure as a BOS, and the fourth one here is the order block. So let's go. The first one we have right here is currency pairs. I should have spoken about it earlier, and honestly I don't know how I forgot about it, but better late than never. So in forex, you are not trading one currency, you are trading pairs, and pairs are two things that are one. You understand? That's why it's called foreign exchange, because they are a pair. Now, example of these currency pairs are Euro USD, which is Euro against the United States dollars, GBP JPY, which is the British pound versus the Japanese yen. You have the USD JPY, which is the US dollar versus the Japanese yen. You mentioned a lot of them. United States dollars, NGN, that's Nigerian naira, a lot of them. You can mention them and list them. The first currency is called the base, and the second one is called the quote. So, example, if you have Euro USD, Euro is called the base, while USD is called what? The quote. Am I making sense? So if Euro USD is equal to 1.1000, it simply means that 1 Euro is equal to 1.1 or is worth $1.1. Now the zeros after the decimal are insignificant. Mathematics knowledge. So when you're buying Euro USD, we are basically saying that you expect the euro to strengthen against the dollar. You get? But when you sell, you are expecting the opposite. You get? So we are going to be diving deeper into the types of pairs. We have the major pairs, minors, and exotics. Now, these are the types of pairs that there is. The first one here is the major pairs. Now, major pairs always includes USD. That's how to know them. So any pair that has USD in it is a major pair. Example: Euro USD, GP USD, GBP, NGN USD. All of these are major pairs. Second one we have here is your cross pairs. Now, cross pairs don't include USD. Example: Euro GBP and the rest of them, no USD in it. And then we have exotic pairs. Now, these exotic pairs includes two currency pairs that one is more stronger, very strong against the other. Example of it is United States dollar versus the Nigerian naira. No, the margin is too big. You have to be honest. So the second one I have right here is risk to reward ratio. It's called RRR. You get your risk to reward ratio. Okay, listen up. This one right here can save you from blowing your account. It can save you from blowing your account. Yes. Risk to reward simply means how much are you risking and to make how much. That is simply what it means. How much are you risking and how much are you targeting to make from that very trade? For example, if you're risking $10 on a very trade now to make $30, your risk to reward ratio here is 1:3. Yes, that means for every $1 risk you make, you stand to gain $3. That's what RRR means. Now, the question here is, why does this matter? Why does RRR matter? Because even if you're not winning all your trades, a good risk to reward ratio can still make you profitable in the long run. That's just how it is. So let's say you lose 3 trades and win 2 out of 5, but your RRR is 1:3. You'll still be in profit, my bro. You'll still be in profit. Now that's how powerful this concept is. So let's ask yourself before entering any trade at all, is this risk I'm making worth the potential reward? You get? So that one we have here is your break of structure. Your break of structure, BOS. I know this one might sound a bit technical, but I'm going to try and simplify it. Break of structure just means that the market is changing direction. That's simply it. You understand? So imagine the market has been going up. That's, creating higher highs and higher lows. If it suddenly fails to make a new high, and drops, that means that it has broken structure. That's what you call break of structure. Now this signifies a potential change in trend or potential trend change. You get? So as traders, We watch these structure breaks, to catch moves, either for a trend reversal or continuation. You get, so you can apply this break of structure in continuation. That if the market is going up, you can actually use it to like continue going up, or when it's time to reverse, that's for you to start selling. You will hear things like BOS to the downside or BOS to the upside. There are just fancy ways of saying the market is doing what? It's switching gears, maybe from drive to park or from park to drive. That's basically what it means. And the fourth one we have is order block. Now we are stepping into my personal trading styles. Order block. I trade order blocks. An order block is a zone where big institutions, that's like your big banks, hedge funds, capital, central banks, likely placed large orders. That's the word there. Now, these zones often act as areas where price reacts or reverses. You understand? So you usually find them as the last bearish candle before a strong bullish move. You understand that? Or the last bullish candle that is up before a strong bearish drop. Am I making sense? Now, when price returns to that area, we expect it to react. Why? Because smart money might still have pending orders there. Now, smart money concept is just like a concept in trading. We have people that trade smart money concepts, ICT, and the rest of them. You understand? It's not magic, but it's powerful when used with confirmation, like break of structural rejections. This very order block pattern. So let's wrap it up. Today, we talked about how currency pairs actually work. And also we talked about why risk to reward ratio keeps you profitable even if you lose some of the time. You understand? And also we talked about how break of structure signals market shifts. And lastly, we talked about how order blocks can show where big players enter the market, like the bank, hedge fund, and central banks. It's very okay if some of this still feels very new. You can watch this video again if you need to. Trust me, it's going to click with time. So next up, I'll be showing you how to place a real trade using MT4 or MT5. Step by step, I'm going to do the Android version and iOS version. So make sure you subscribe with your bell icon on, because we are taking things to the chart in the next episode. This is DivyFX once again, where Forex finally starts to make sense. Catch you in the next one. Thank you very much.